Good morning and welcome back to Margin. This morning we're going to talk about what the difference between a HELOC and a home equity loan is. So let's jump right into it. So if you own a home, you may have heard of or used a product called a HELOC, otherwise known as a home equity line of credit, or maybe you have utilized a home equity loan at some point. So these are loans against the equity you have in your home. So let's say that you have purchased your home for $215,000 back in 2011, and now here in 2021, that home is worth $345,000. So equity is the difference between what the home is worth and the note or the loan, the mortgage balance that you have against that property. So let's say that you still owe $171,471.21 based on the amortization schedule of paying $1,083 per month of principal and interest for 10 years. So that's just looking at the amortization schedule and looking at 10 years down the road to the exact month how much you have actually paid down on that property. So your equity would be the difference between what the home appraises for, the market value of that home, for the comparable sales that you've seen in your neighborhood or in your area. And in this case, it would be $345,000. That would be the market value minus your current balance of that $171,000, equaling $173,528.79. Now that's a nice sum of equity, and most believe that you should have access to all of that equity. But that's not necessarily the case, and that's not typically how banks and institutions see this equity. Usually banks and institutions will finance up to 80% of the market value. So this means that the value would be set at $276,000 minus what you currently owe at the $171,000. That equals about $104,000 in equity that you can loan up to, so loan against. Now, of course, each bank or financial institution will have different limitations and restrictions and everything else based on the amount that they will loan on your equity. Now, you want to shop around and figure out what is the best fit, best rates and terms for your needs. Now, assuming that you take advantage of utilizing all $104,000, you can then set it up as a home equity line of credit or a home equity loan. A home equity line of credit will allow you to use whatever portion of that $104,000 you would like, and your payment will then be made and determined based on your utilization of that amount. So these loans typically have to be renewed on an annual basis. They are reevaluated at that point and come with a variable rate interest rate based on the market. Now, this variable rate will be assessed based on the utilized amount and amortized out to provide a minimum payment you must pay. So this is similar to a credit card, and basically you would end up just making the payments based on your utilization. Now, assuming you have this same $104,000 available to you, you may opt for a home equity loan, whereas you would request up to the approved amount as a fixed loan instead of a variable loan. Now, this loan would have a fixed interest rate and monthly payment and would be amortized over a certain fixed period of time. So I would be very careful about when and if, and also to what extent you tap into your home equity. I want to put that there and preface that because it's so important that you don't drain your equity, especially in a time where there could be some fluctuations in pricing. So doing everything in your power to get your mortgage paid in full as quickly as possible will ensure that you are opening up options for you, your family, and so on and so forth. Having a monthly mortgage amount limits your disposable income for other purposes, and home equity products will further limit you. Now, I have used home equity vehicles or home equity loans before just for the purpose of having options. Now, I have only gone the home equity line of credit route, as I would utilize it for a remodel or a renovation. But I also know that those two options are typically offered side by side, and usually you select between them. So I like this option for the purpose of building more equity into your home. I know many people utilize home equity loans to pay their kids' schooling, to buy vehicles, or as a bailout to pay off your credit cards, so you feel like you're making moves to pay off your debt. But be very careful how you use the equity in your home, and be sure to spend that equity on something that will increase in value, not on a depreciating asset like a vehicle typically is, or a vacation, maybe electronics, or to pay off or consolidate other debt. So all that said, you may be asking which one is better. And my response is that it really depends on your use. It depends on what you plan to use it for. If you know exactly what your kitchen remodel will cost, for example, and you utilize a home equity loan at a lower fixed rate to have a fixed amount provided to you, then that's a perfect application for that. Now, if you are just trying to give yourself some additional options, you may consider a home equity line of credit instead, so that you can utilize only what you need if and when you do need it, and then you can focus on paying that back down and off. So that line of credit stays open for you, and you can reuse it over and over again for various purposes. So with any of these products, I would use them sparingly. You may have recently heard of Wells Fargo dropping their consumer lines of credit. This was a move commonly seen in the last downturn, as banks and financial institutions tightened their belts and limited their risk by doing so. So when economic conditions are unknown, these are an easy target in either limiting the credit available to consumers or canceling the credit altogether that is not utilized. Now, what could happen that's even worse than either of those situations is that the bank or financial institution can call the loan, causing you to be in a place where you have to pay back that HELOC or that home equity loan with cash or with a loan from another institution that you would have to get. But if they're calling those loans, there's most likely a level of uncertainty in the market, and other banks and institutions may not actually cover that debt for you and actually provide you with a loan because they're doing the same. Now, of course, you can see how this could wreak havoc on someone's personal finances who did not have the cash available to utilize for what they placed on that home equity loan in the first place. Now, the moral of the story is that these home equity loan products can be great for short-term use, but don't rely on them for recurring use. I know that the home equity line of credit can be used over and over again, renews once a year, and so on and so forth, but don't treat it as though it's something that you're going to constantly keep a balance on. So much like a credit card, be sure to never use it as a slush fund, as an emergency fund, or as a means to buy whatever you want to support your lifestyle. But be strategic with what you use it for and how you're going to then pay it off. So my call to action today is to consider these products and utilize a home equity product if your options are using maybe a credit card instead. My recommendation, though, is to have a plan for your purchases. Plan for your remodels and make sure that you are not just blindly utilizing credit to support your lifestyle. If this information is helpful to you, please do like, subscribe, and hit the notification bell so you're reminded to come back on a daily basis and improve in managing your personal finances. Thank you for your time. Enjoy your day. We'll see you back here tomorrow.